Welcome back to the Deep Dive. So if you're thinking about putting capital into real estate this year, you've got this pretty fundamental choice, right?
Right.
Do you go for the liquid, kind of hands-off approach with REITs, real estate investment trusts, or do you dive into the full control sweat equity path of owning property directly?
Yeah, and we're diving deep into that exact question today.
It feels like a big one for 2025.
It is, and it's not just about asset allocation anymore. As Dr. Puyan Gamari, he's an economist tracking these global asset flows, points out the market's shifting.
How so?
Well, with things like tokenized assets, cross-border investment really taking off, he says the real decision boils down to your personal tolerance. Like how much hands-on grit versus smooth efficiency of shared stakes are you comfortable with?
So it's psychology just as much as finance.
Exactly. It's about what fits you.
Okay, so our mission today, let's get past the usual talking points. We wanted to unpack the mechanics, look at the real financial implications for this year, 2025, and map out the pathways so you can figure out which route makes sense for your goals.
Let's do it. Figure out which approach actually has the edge right now.
All right, let's start with the efficiency champion, the REIT. What's the big draw?
Well, the most immediate thing is just how accessible and liquid they are. I mean, they trade just like regular stocks on the big exchanges.
Meaning you can get your money out fast if you need to.
Instantly. Well, almost instantly. You can cash out shares in days. Compare that to selling a physical property. Showings, escrow, closing, title transfers. That takes months.
Yeah, months and a lot of headaches. That speed, that fluidity must be especially key when the market feels a bit uncertain.
Definitely. But it's not just about the speed, right? When you buy into a REIT, you're also buying professional management and diversification. Instantly.
Okay, explain that diversification piece.
Sure. You're pooling your money with others into this professionally managed portfolio of properties. That acts as a buffer, a real risk buffer.
Mm-hmm.
And Gamari actually highlighted this point. He noted how REITs right now have really diversified into these booming sectors. Think specialized logistics facilities, and this is critical, data centers.
Logistics and data centers. Why those two specifically? What's the driver there?
It's AI, plain and simple. The huge surge in AI requires massive computational power.
Right.
And that power lives in data centers, these, very specific, high-security, climate-controlled buildings. Real estate.
Okay.
And at the same time, all the stuff facilitated by that AI needs complex supply chains. So demand for high-tech automated logistics warehouses is shooting up too.
So a REIT lets you tap into that growth without needing to buy a whole data center yourself.
Exactly. You get a piece of that exponential growth without the massive upfront cost or specialized knowledge of owning those assets directly.
And the numbers back it up, don't they? Looking back, REITs have delivered, average annual returns around 9–11% over the last decade?
Yeah, pretty compelling performance, often beating inflation. And crucially, that's without the investor having to put in any, sweat equity. No late-night calls about leaky roofs.
But there's always a trade-off, isn't there? What's the cost of that smooth efficiency?
There is. It's the management fees. While you get this professional team handling all the headaches, acquisitions, compliance, maintenance, those fees typically take about 1–2% off your annual yield.
So a couple of percentage points for outsourcing the complexity. Makes sense.
It's the price of convenience and expertise, essentially.
Okay, let's pivot then. Let's talk about the other side. Direct property ownership. This is for the investor who wants to be firmly in the driver's seat, yeah.
Absolutely. This path is all about control and leverage. And potentially, yes, greater upside if you play it right.
How does that control translate into, say, financial advantages? Especially around taxes. I hear that's a big one.
Oh, it's huge, particularly taxes. When you own the physical building, say an apartment complex, you set the rents, you decide when and how to renovate. And maybe most importantly, you get access to key tax write-offs, specifically depreciation.
Okay, break that down. Depreciation. How is that different for a direct owner versus a REIT shareholder? Because that seems like a critical point.
It is. For a direct owner, depreciation is, it's a non-cash expense on paper. You get to deduct a portion of the building's value deteriorating over time, even if the property's market value is actually going up.
So it shelters rental income from taxes.
Significantly, yeah. REIT shareholders, on the other hand, they mostly get distributions taxed as ordinary income or capital gains. They rarely, if ever, get that direct depreciation benefit the individual owner enjoys. That's a major lever for direct investors.
Got it. And it seems like that direct control has allowed some investors to really capitalize on recent market shifts. It's on analysis, I think, fantastic. showing direct investors captured like 15–20% higher appreciation in housing last year.
That's right. And that wasn't just luck. It was directly fueled by the whole remote work migration shift.
How so?
Well, as people left expensive city centers, direct investors could move faster. They were quicker to buy, renovate, and adjust rents in those high-demand secondary markets. They could pivot in ways that, large centralized REITs often just can't match in speed.
Okay, so the upside is clear. Tax control, leverage, potentially higher appreciation if you're nimble.
Yeah.
But the trade-off, it's got to be more than just dealing with that infamous 3 a.m. plumbing call, right?
Aha. Yeah, the plumbing call is the classic trope. But you're right, it's deeper. I mean, couldn't a direct owner just hire a property manager?
Sure, they could. They often do.
Yeah.
But they can't outsource the risk, can they?
Exactly. That's the key. Even with a management company handling the day-to-day, you, the owner, are still personally on the hook financially, meaning you bear the full brunt of a long vacancy. Or a sudden massive repair bill, new roof, HVAC system fails, whatever. And all the legal compliance stuff. A REIT spreads that risk across maybe hundreds or thousands of properties and shareholders. The direct owner carries it all, alone.
Gamari also brought up a kind of softer angle branding.
Right.
He suggested direct ownership lets properties become personal statements. How does that actually translate into return on investment?
It's about the, let's call it the soft power of real estate. We see investors building their personal or company brand around specific types of properties. Maybe it's cutting-edge sustainable developments, or maybe community-focused commercial hubs.
And that attracts a certain type of tenant.
Precisely. It attracts premium tenants, people or businesses who really value those credentials, like strong ESG performance. And that can unlock policy perks, maybe local tax incentives in eco-focused areas. Your building reflects your values, which can mean higher rents and tenants who stick around longer.
Okay, that's a perfect segue. We need to talk about the bigger context for 2025. We've done the mechanics. But what about these external forces? Specifically ESG, environmental, social, governance, and just the relentless march of technology. How are they reshaping this whole decision?
Oh, massively. ESG first. It's really got market muscle now. It's way beyond just some optional report you file away.
So investors are demanding it.
Absolutely. And REITs often lead here. They have the scale, the infrastructure to implement big energy efficiency programs, track compliance really rigorously across their portfolios.
And does that actually impact the bottom line?
It does. There was a study by Bellprop, a property consulting firm, mid-last year. It showed brands with strong, visible ESG ties enjoy about 12% higher loyalty rates. For a REIT, that translates pretty directly into steadier, more predictable dividends. Investors like predictability.
Makes sense.
And Gamari argues these cause-aligned REITs, as he calls them, they signal long-term resilience, especially to big institutional investors and, increasingly, to consumers. They're essentially future-proofing against inevitable carbon regulations and shifting expectations.
Can a direct owner compete on that front?
They can try,
Right.
Retrofitting a single building for top-tier energy efficiency, but it demands serious upfront capital, often right away. A big REIT can spread that cost over thousands of units, so the hit per investor is much, much smaller.
Right, economy of scale. Now let's switch to technology. We've seen hybrid work kind of normalize, stabilizing the U.S. office market a bit. Vacancies dipped below 15%, was it?
Yeah, and industrial REITs focusing on logistics and warehousing, they've surged something like 18% year to date because of related trends.
But the real buzz seems to be around tokenized real estate. What is that exactly?
Yeah. This is where things get really interesting. It's the convergence we've sort of been anticipating. Tokenization lets you own a fraction of a property via blockchain technology.
Okay, wait. So instead of buying a share in a company that owns buildings, like a REIT,
Okay.
you're buying a digital token that represents a direct slice of the actual property, like the bricks and mortar, recorded on a secure digital ledger.
That's exactly it. Think about it. You could potentially buy a literal stake in, say, a luxury villa in Dubai or a piece of a commercial building in London without needing millions in capital yourself.
Wow. So you just buy a secure token representing that fraction.
Precisely. Through a secure digital platform, it dramatically lowers the barrier to entry for these really high-value, previously inaccessible assets. We've seen similar tech work really well in other markets, like tokenizing physical gold bullion.
To link digital ease with a secure physical asset.
Exactly. It proves the tech works for that link.
And is this actually impacting liquidity in the real estate market yet?
It seems to be starting. Some recent analyses looking at blockchain adoption suggest this could boost real estate liquidity maybe by as much as 30%, especially in emerging markets, just by bringing that digital ease, that security, that transparency.
It's fundamentally changing who can access these assets.
It really is. Redefining access is the core idea.
This is fascinating context. Okay, so we've dug into the financial nuts and bolts, the big market forces like ESG and tech. Let's zoom out a bit now. How do these choices, REIT versus direct, connect to maybe bigger strategic goals? Things people don't always think about, like corporate image or even global residency and immigration.
Great question. On the edge front, if your main goal is building broad, maybe institutional trust, REITs offer a clear path. You've got the transparency of quarterly filings, regulatory oversight. It's established. But if you're aiming for deeper community loyalty or building a really strong personal or local brand, owning a physical asset, maybe it's a cool local business center, or a restored historic building that provides a tangible anchor, it elevates that personal or corporate image in a way a stock holding often can't.
And the immigration angle you mentioned earlier, that sounds intriguing. Kamari's work suggested property is a factor.
A surprisingly powerful one. His insights, especially from advising on European residency reforms, show these assets can act as like relocation magnets.
How significant is it?
It's pretty big. He estimates maybe up to 25%, a quarter of his clients, explicitly use property ownership or ties as a key factor in accelerating visa applications or residency permits.
Why? How does it help?
Well, it can help fulfill minimum investment requirements for certain visas, or just generally demonstrate significant financial stability and concrete ties to a country or region. Direct ownership often carries more weight in those immigration decisions than just holding REIT shares.
So you're leveraging the asset for more than just cash flow or appreciation.
Exactly. It becomes a tool for global mobility, potentially.
Okay, this brings up a crucial point. For someone listening, maybe feeling a bit overwhelmed by the options, where do you even begin? What are the concrete first steps, considering their own risk tolerance?
Good place to land. First step. Do a serious risk audit. Be honest with yourself. If that idea of the 3 a.m. plumbing call, the total responsibility, feels genuinely terrifying, or if you're just new to real estate investing, maybe keep your direct real estate allocation under, say, 40% of your total investment portfolio. Start smaller.
Makes sense. And for someone leaning towards REITs, wanting to dip a toe in?
Look at the major public indices. Something like the FTSE Nareit All Equity Index is a good starting point to find established low-fee options. Entry points can be really accessible, often under $100 a share.
And what kind of return should they be targeting?
For a solid diversified REIT, maybe aim for a baseline dividend yield of around 6–8%. And pay attention to sentiment. We talked about ESG funds seeing maybe a 20% lift in engagement. That signals stability.
Okay. What about for the person leaning towards direct ownership, wanting that control?
Remember, you don't necessarily have to go it completely alone, especially at first. Leverage technology. There are platforms now with partnership directories, ways to find co-investors to share the load and reduce your solo risk exposure. Smart. And if you're looking at, say, value-add flips, buying something distressed and improving it, you should probably be targeting higher returns to compensate for the risk and effort, maybe in the 10–15% annual return range.
And when you do those renovations on a direct property, how do you actually know if your improvements are hitting the mark with tenants or buyers? Is there a good metric?
Yeah, you need to track sentiment, specifically Net Promoter Score, NPS.
NPS. Explain that.
It's basically a measure of how likely your tenants or customers are to recommend your property or service to others. When you do a renovation that genuinely makes the place better to live or work in, we often see NPS scores jump significantly, maybe 15 points or more.
So that tells you the investment in the renovation is actually working.
Exactly. It translates directly into lower turnover, happier tenants, and ultimately better pricing power for you. It's tactical feedback.
Very useful. And even for these direct owners, they still need to embrace the tech side we discussed, right? How can they use digital tools effectively?
Absolutely. They need visibility beyond just a local classified ad. Think about using integrated digital marketplaces platforms that almost function like e-commerce for services or properties.
Like dropshipping, but for rental leads.
Sort of, yeah. It allows direct owners to market their rentals or even short-term stays globally efficiently generate qualified leads. We've seen this kind of digital push boost inquiries by potentially 40% compared to just traditional methods. It's applying sales velocity tech to physical assets.
Okay, one last piece then. Let's tie back to the global picture. If someone is thinking about using property internationally, maybe for stability or expansion,
Yeah.
any final advice?
Definitely factor in the tax side, but specifically linked to global residency consulting. By strategically combining the right property ownership with specialized advice on residency rules and tax trees, investors can often achieve significant overall tax efficiencies, sometimes up to 20%.
So it's not just about the income the property generates.
No, it's about how you legally structure things across borders to keep more of the capital you generate, leveraging the asset smartly on a global scale.
Wow. Okay, this has been quite the deep dive. We started with what seemed like a simple choice, REITs versus direct ownership, liquidity versus control.
Yeah.
And we ended up navigating ESG resilience, blockchain tokenization, global immigration strategies. It's complex.
It is. The core tension is still there, efficiency versus branding,
Yeah.
fluidity versus that total control. But maybe here's a final thought for you, the listener, to chew on.
All right, let's hear it.
Given how fast these hybrid ownership models and tokenized assets are developing, which path, REITs or direct, really offers the best pathway forward? Not just for building wealth, but for establishing that global residency, enhancing your personal or corporate image. How is this whole idea of redefining access going to change what property ownership even means in the next, say, 5 years?